Monday, January 27th, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, of course, there's a lot going on in the markets as it relates to the coronavirus that's starting to spread from China. But I'm going to cover the US Treasury yield curve because we haven't really been talking too much about it. There's been a lot of talk about the repo, of course, lately, but the US yield curve is starting to invert again, which is usually not a good sign for the economy. It started inverting back in late 2018, and it made actually the Fed reverse its policy of tightening rates, of unwinding its balance sheet. So it's very important that we look at the US Treasury yield curve, that it's inverting. Before that, of course, I'm going to quickly look at the markets this morning here in London. I think the markets are going to be very choppy this week because of what's happening in China with this coronavirus. So it's just before 7:30 a.m. Just quickly look at some of the headlines we see here. Investing.com says stocks, oil prices skid as China virus fears drive investors into safe havens. What else have we got? Zero Hedge, coronavirus latest, 2,799 global cases resulting in 80 fatalities. FT, the coronavirus is not their top headline. But it says here, one of their stories, China braces for blow to economic growth from coronavirus. Wall Street Journal, China urges calm over virus during critical period. So this could spread, of course, and it could be quite serious. As I said, though, I'm not going to go into it. There's a lot of other people that are covering this. I want to stick to what I know well, the markets, the yield curve today. One thing I would say, though, if things get really bad with this virus, that could be an excuse to close the markets, financial markets, just like they did after 9/11. They closed it for a week. Am I saying that's going to happen? No, but that's something you need to keep in mind. I'm not trying to panic here, but I'm just saying. So let's see what the markets are doing. We've got spot gold up about $6 at $15.78. It has been as high as $15.88. It went there early yesterday in the overnight session, but it's been coming off. I'm sure there is some kind of control of the price, of course, as we know. Silver got up to 1840 almost overnight, and now is at 1817. So they've gotten silver under control. It's now at 1818, up 6. One thing I would say about silver, that colloidal silver is a very good antivirus, anti-infection, and with this coronavirus, it could be very positive for silver. Colloidal silver. Look it up. The Dow right now is at 28,686, down 300, the Dow futures. It has been down as much as 330. So we are near the lows, down 1%. S&P is down 1% at 3260, down 34. Nasdaq 100 future is down 122. Or 1.34%, just above 9,000. The currencies, sterling is fairly steady, 130.68, down very slightly. The euro slightly higher versus the dollar, 110.34. Dollar down 0.2% against the Japanese yen at 109.06, and the dollar is up 0.5% against the Chinese yuan, which is not surprising. We're at around 696.70. So crude oil, WTI is down 2.3% at 52.90, and Brent is down 2.3 as well at 58.60. Now to the bond market. to the yield curve. So why is a inverted yield curve a bad sign for the economy? First of all, an inverted yield curve means that shorter term rates are higher than the longer term rates. Normally, in the normal bond market, shorter term rates are lower than the longer term rates because there's more risk lending money over the long term. So you demand more yield, more interest from the borrowers. So, and why does it point to a slowing economy, an inverted yield curve? Well, because it means that the banks are not going to make as much profits, because banks usually borrow short term and then they lend long term, so they make the difference. But if short term rates go up and longer term rates go down, banks will have trouble making money, making a profit in that arbitrage of rates. So they won't lend as much. They don't lend as much. People don't borrow as much. They can't spend as much. We know that the US economy and most of the Western economy is based a lot on consumption, and that's why it could mean a slowdown in the economy. So I'll show you here a little chart from investing.com. You can see that a month ago, the red line from 1 year all the way up to 30 year, the curve was upward sloping. You can see the blue line underneath it now. The 1 year is above the 2, 3, 5, not the 7. So the curve is starting to invert. The longer term rates there are higher than the shorter term rates. I'll show you as well the effective Fed funds interest rate, which is the target rate that the Federal Reserve set to for federal banking institutions, for national banks to lend to each other overnight. That's the Fed funds effective rate. The target right now is 150 to 175, but you can see that the effective Fed funds rate right now is 155. So let's go back to that little investing.com yield page, US Treasury yield page. So you can see that the 1 year yield here is 154, so that's below 155. The 2 years at 146, that's like 9 basis points underneath the Fed funds rate. You can see the 5 years at 146, and it's down 3.5 today. The 7 year is at 156, very close to inverting now as well. And the 10 year is still 10 basis points away, but it looks like we could invert the way things are going. Yields have been dropping in the longer end for the last week. I wouldn't be surprised if the curve from Fed funds to the 10-year inverts very soon, and that's not a very good sign. That's a sign of an economic slowdown. The Federal Reserve is meeting this week. I don't expect them, the FOMC, to change rates, but they could very well start looking at it for the next meeting. They could use what's happening in China as an excuse. They have been known to talk about effects of economic activity overseas, and especially China now. If there is a slowdown, economic slowdown, which is very likely from this outbreak of coronavirus, it could lead to the Fed cutting rates at their next meeting. So yeah, the FOMC meets tomorrow and Wednesday. They will make their decision on Wednesday. Don't expect them to do anything with rates. But by March 17th, 18th, when they have their next meeting, a lot could happen. And I have a feeling they might start thinking about cutting rates. They might start thinking about more QE. So that's what it's pointing to me. What's happening in China, it could be a trigger for the Fed. And I think the yield curve, this has been happening. The yield curve, the inversion has been happening even before the events in China pertaining to this coronavirus. So there you go. The markets are going to be very volatile, as I said. Is there a danger of the markets being shut? It's a possibility if this coronavirus spreads and gets really bad, not only for China, but around the world. We've seen that they've quarantined about 40 million people around the Hubei province, which is where Wuhan is. They've got emergency level notices for cities like Beijing. So this is quite serious, it looks like. So what about precious metals? Yeah, doesn't change anything for me. It's again, if the markets are closed and you can't access your investments, your stock market investments, bond investments, but you've got your precious metals in hand with no counterparty risk, you'll feel good about it. Granted, I don't think if the stock market is closed, it's going to be for a long time, but you never know. During World War I, even the US, New York Stock Exchange was closed for months when the war started in 1914, even though the United States only joined that war in 1917. So there you go. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. Please share this video far and wide. And you can also follow me on Twitter, BitChute, Steemit, and DTube. I wish you all a great week. Take care. Bye.